Today we are talking about 10 trading strategies and how to use each trading strategy to find the best trading opportunities. So hello, welcome back, and this is going to be a special video with all of those 10 trading strategies. You will find the timestamps underneath the video. And if you have any questions, make sure to leave a comment, leave a thumbs up, share this video with your trading friends, and I will be making more in the future. So the first one is the Engulfing Pinbar trading strategy. I know a lot of traders know the engulfing bar. I know a lot of people know the pin bar. But when we put those two together, we can find even better trading opportunities. And a pin bar and an engulfing pin bar looks something like this. It has both characteristics of each candlestick. So we have a pin bar that is showing here this long wick. And we have also the engulfing component, which means that this candle is completely engulfing the previous candlestick. And in this example, it's even engulfing the previous 1, 2, 3, 4, 5, 6 candlesticks. So even a much stronger momentum signal. So the pin bar and the wick of the pin bar is showing that the market is rejecting the highs. The low and the close of the pin bar is showing that the price is moving away from the end of the wick. And the engulfing component of this candlestick is showing that there's actually a high momentum move going on. And in this example, you can see afterwards the market completely sold off. A long trend was started after this engulfing pin bar. So use those things maybe even for a higher time frame and multi-time frame approach. You can use those across all the time frames. In this example, this is the 12-hour time frame. You can go down all the way to the 1 hour or to the 4 hour once you have identified such a engulfing pin bar, and then try to trade it into the direction of the trend. Here another example, this is now on the 4 hour, and you can use it across all the time frames. And it is very important that you only look for engulfing pin bars that are exceptionally strong. So you need to have the signal of a very long wick, like in this example and in the second one as well. So you can see the wicks are really taking out the previous highs in both examples. You can see that in both examples also the body close is bearish. So it's on the opposite side of the pin bar wick. And it is also completely engulfing the previous candlesticks in both examples. The second example is even showing you a much stronger close with a longer body, and the close of the body is close to the low of the candlestick. So great signals. I really recommend that you start looking for them. You can use those engulfing pin bars also around previous highs and lows at the end of trends. And I am making a new video which you will also find on my YouTube channel. So make sure to subscribe so that you will get notified once this new video about engulfing pin bars drops. The second one is one of my favorite strategies. It's the breakout buildup. And this is how it looks like. You are looking for a breakout buildup after a strong trend. Once the strong trend is losing momentum and once the strong trend is going into a sideways phase, you start drawing your support and resistance level. And before a breakout, you will often see something like this. A small consolidation. Here you can even see we also have something like an inside pin bar or engulfing pin bar in this case as well. And this foreshadows very often a successful breakout. What does it mean? It means that before the breakout, the market was not able to pull away from the level at all. So the price really stuck to the level. And this can tell us that there's actually already a lot of selling going on and a lot of selling pressure is building in this market. And the breakout buildup can be a great tool to add to your repertoire. Here as well, the price is coming from a strong downtrend. Then the downtrend loses momentum. It goes into this triple bottom. At the same time, you're establishing this resistance level here. And before the breakout, the market is really sticking to the level. It's building a lot of pressure. And then you can see it gaps above the resistance level. And then the price takes off. So this is a very successful and a very great trading strategy that you can look into and you should look into. The Bollinger Band spike is our next trading strategy, and this is a strategy that I use to trade for a very long time. For that, you first set your Bollinger Bands to 2.5 standard deviations, which means that they are going to be a little bit wider than the regular 2.0 standard deviation. And this will help you filter out spikes that don't have a significant meaning. So here in this example, you can see we have two spikes. Both are going through the outer Bollinger Bands. And then what you want to see in both examples, by the way, it's also in a pin bar. So you can add the pin bars criteria to this strategy as well. And then you wait for the price action to break into a new high. So here you can see I drew the horizontal purple levels or pink. And once the price closes above the high and once the price breaks into a new high, then a new trend is often started, and then the market is really pulling away from the Bollinger Band spike. In the first example, you can see we have a great spike, but the price never closed above this previous candle that is actually doing the spike. So this would have never got triggered, and it's really important that you add such a trigger filter, because very, very often a spike outside of the Bollinger Bands could also mean that the market is still in a very strong trending phase. It doesn't automatically mean that the market is going to reverse. So you need to wait for the market to really close and trigger the previous high of such a spike. Although this is a very weak spike here, the first example, this is still a valid spike. And then you can see the market broke above this area and broke above a new high. You could also think about and try to trade those with pending orders. So once you have identified your pin bar spike or your Bollinger Band spike, you put your pending order above the previous spike. Here, another example, we have multiple spikes. You can see here's the first time it spiked, and then here's the second one. But it wasn't really until the market broke below this line into new low that the trend here really accelerated and that the move away from the Bollinger Band spike really was initiated. So it's really, really important that you need to have a valid spike and you need to see that the market is really pulling away from your spike direction. Here as well, another spike, and then here is where the market drove into a new low. And this is where the spike really was triggered once the market moved into and really closed outside of a new into a new low. And you can use this again with a multi-time frame approach. So once you have identified your 4-hour spike, like in this example, you could go down to the 1 hour, to the 30-minute, to the 15-minute, and wait for the market to close below the previous lows and then manage your trade accordingly. RSI divergences are a great tool and they're really, really powerful. So let's get into an example here. First of all, it's very important that you only use a divergence and that you only trade divergences after or during strong trending markets. Divergences don't work during sideways markets. And you can see I also applied a 50-period moving average to this chart just to help us identify the trend. So here you can see the market was trading below the moving average. And then here we are seeing a double divergence. And you can see the price is making a lower low, whereas the divergence is making a higher low. And then the market broke above the moving average and started a new downtrend. There are multiple ways how you can and how you could trade such a setup. First, and which is what most traders do, is that they look for some support and resistance level, some pattern in the divergence. So here we can clearly identify a resistance level. And once the market breaks above it, you would initiate your long. Other people who are getting into later are waiting for the moving average also to break, but this is a very late entry. And then you can see the market went to an uptrend, and here we have a triple top and also a divergence. And then shortly after divergence, the market completely sold off into a new downtrend. So it's really important that you don't trade divergences all over the place and you only trade divergences after strong trending markets. You can use a moving average to help you identify those phases. Here, another example, the market is really pulling away and you want to see that the market is really spending some time away from the moving average. That's really important to help you identify long-term trends. And you can see here a clean divergence. The price is making higher highs, the indicator is making lower highs, and afterwards a new downtrend was initiated. And you could also add a criteria of engulfing pin bars. Very often you will see that those divergences and those second tops, they come with a divergence or with a Bollinger Band spike or with an engulfing pin bar as well. So you can even layer those rules and those strategies on top of each other. Fibonacci extensions, I made a few videos and I got a lot of feedback and a lot of interest around Fibonacci. So if you want to know more about Fibonacci's, make sure to leave a comment below and I'm happy to help you out. And the way the Fibonacci extension strategy works is that, again, you look for a trend and then you wait for the trend to turn around. And once you have identified this A, B, C pattern, then you can draw your Fibonacci. So once we have your A move, you wait for the first trend wave to end. Then you look for the Fibonacci retracement. In this example, a very, very precise 38.2 Fibonacci retracement. And you need to see that the price is really expecting and respecting the Fibonacci retracement. So if the retracement is not adhering to any Fibonacci retracement line, then you cannot use the Fibonacci extension. But once you see that the market has found support at one of those retracement levels, then you could start looking for trades into the direction of the Fibonacci and of the new trend. And very popular targets are often the 138.2 or the 161.8. And very, very often you will see that the market is respecting those Fibonacci extensions to the pip. So really, really powerful strategies. Many big hedge funds, many algorithms also are Fibonacci based, or they use Fibonacci based trading strategies because they are very simple to program and very, very robust. And here again, the market is coming from a downtrend. Here's the end of the downtrend. Then we wait for the first trend wave into the new direction, which is coming to an end here. So we start drawing our Fibonacci from here to here. Then we see we have a perfect 50-point retracement here on the Fibonacci. And then we look for ways how to get into this new trend direction. And again, the market jumps into 161.8, it jumps and respects the 200, and it finally turns at the 261.8 and then turns around and starts a new trend. And you can see this is really, really powerful. 161, 138, 200 and 261 are great levels. They are often used among the big money, among the big players. So really, I encourage you to start looking at those. It's going to be a really interesting journey once you realize how powerful those Fibonacci levels are. Pullbacks are very popular, so we cannot really miss a pullback strategy when we're talking about trading strategies. And again, I really encourage you to use a long-term moving average. In this case, I have used a 100-period moving average. It helps us identify the trend direction. And once you see that, okay, now we are in a downtrend because the market is trading below the moving average, then you wait for consolidations. Here in this example, we can define the consolidation with the trend line. We can really nicely define this flag or this pullback phase. And you simply wait for the trend line to break before you initiate your entry into the trend direction. And here again, we have a new trending wave. Then the market shortly consolidates. You can see we have a very precise support level. And once it breaks, the new trend wave is initiated. The market comes back into the previous support and then sells off again. And now this is another example, a 100-period moving average. So we can see the market is in a long-term downtrend. The price is trading below this moving average. And this is really helping you, and pullbacks in general are helping you to understand the natural flow and the rhythm of price. When you have a trend, the market and the price doesn't just shoot up in one straight line or shoots down in a downtrend, but it always goes in those wave phases. That's really, really important. And a pullback trader will learn to read those wave phases, and he will understand that this is really how all the markets work. You have a trending phase, you have a consolidation, you have a trend, consolidation, trend, consolidation, and so on and so forth. And this is going to help you to time your trades. You wait for the market to enter a consolidation, and then once the momentum picks up, you can initiate a new trend. Then you wait for the market to consolidate again, you wait for the breakout, you can initiate a trade again. Or you even look for trading pullbacks into those previous support resistance areas here and then trade the retests. There are so many options and so many opportunities when looking at pullbacks, and I made a bunch of videos and articles for pullback trading, so make sure to check that out in my channel as well. MA crossing, it's not the same as moving average crossover signals or systems, so let's take a look at a few examples. So generally, you use a lower and a higher time frame. In this example, I have a 50 and a 20 period. You really want to make sure that your time frames that you're using are at least a factor of 2 apart from each other. So using a crossover or moving average that are like 50 and 40 periods, it's usually not as helpful because the moving averages, they're not far away enough from each other. So in this example, we have 50 and 25, and a general moving average crossover system would look for just the moving averages to cross, obviously. So here would have been a long signal, here would have been a short signal. However, those crosses will often happen way too late. And a more aggressive approach would be to just wait for the price to break above the both moving average to look for longs, and wait for the price to break below the 2 moving averages to look for short opportunities. This will usually give you a much earlier entry signal and help you reduce the lag of such a moving average crossover signal. Here as well, you can see the market is crossing and going up and down a lot. The moving average crossover would have happened here, which is way too late. Here, this would have been already down in the downtrend, and in this uptrend here at the right-hand side, the cross would have been very late. But waiting for just the price to cross through the moving averages may give you much earlier trading opportunities, so you can reduce the lag that many people just don't like. On the other hand, it's very important to understand that moving averages can only be used in trending markets. So you may need to apply a trending filter. And in the last trading strategy, when we look at the tunnel trading strategy, I will show you how to use the RSI as, we can call it a tiebreaker for trending phases. But before that, let's talk about trendline retests. And trendline retests are very, very powerful. So once you have identified 2 swing points of your trend line, so here we have the origin, here we have the second point of the trend line, and then you can wait for the market to get back to such a long-term trend line and trade into the trend direction. So in this example, you may have been entering here and here on the second and the third pullback into such a trend line. So this is something for trend following traders who are looking for better entry opportunities when the market is giving you a better entry price. The problem of many trend following traders is that they enter too late and then they chase price, but with a pullback strategy like this one, you are entering when the market is actually giving you a better entry price. Here, another example, we have our first 2 touch points. Then you have another touch point where you could already look for trading opportunities, and then here as well. This is the daily chart. So once you have identified your trend line on the higher time frames, you may even go down to the 4-hour or the 1 hour and pinpoint your trading entries with the multi-time frame approach. Once you have identified a trend line, go to a lower time frame and then look for your entries into the trend direction. This is going to help you improve your odds significantly. Supply and demand, always a very, very popular strategy approach, and supply and demand can be used in combination with other trading strategies as well. So what you want is you look for strong supply and demand areas. Strong supply and demand areas are usually small consolidations before strong price moves. It's very, very important that you have a very strong price move away from such a supply and demand area. Only then are you looking at a valid supply and demand area. And you don't only want to see a strong move away, but preferably you want to see really that those happen during strong trending markets, because it just means that there is a lot of selling power behind this move. Here again, a lot of selling power, because you can see how far the price is really dropping afterwards. And then you simply wait for the price to get there, and then you go to a lower time frame maybe and try to pinpoint your entries. In this example, you have an engulfing bar here at the first supply zone, and you can see how strong the price dropped afterwards again, almost back into the previous lows even, once it picked up all this supply. And then here the market eventually moved into the second supply, the higher one, and again found some support or resistance in this case. Here the market overshot this area then afterwards and started a new downtrend. So there are multiple ways how you can use those supply and demand areas. Here a very, very popular example that we traded as well. So you can see here was a supply and demand area at the origin of this huge drop. The market really dropped in a vertical line, and this means that there's going to be a lot of supply and a lot of selling pressure in this area. And then you just simply wait for the market to get back there, and once it reaches this lower end of the supply area, you could go to a lower time frame and look for trading opportunities with your other trading strategies. And here, even in the second time, the market came back, picked up a lot of supply, and then dropped significantly and initiated a new downtrend. The tunnel riding is something that has gained a lot of attraction, so let's look into this. And there's another video that I made specifically only about the moving average tunnel system. So for that, we use two moving averages. Both have the 20 period. One uses the high and one uses the low. You can set it up on all trading platforms. And here is the RSI, the 14 period. And I drew a line at the 50 level to help us distinguish between bullish and bearish trends. So as long as the market is above the 50 line, it means that you are in a bullish market. And once the market is below the 50, you are in a bearish market. And then you simply look for ways, once you're in the trade, you can use the tunnels as well to ride your trends and to ride your trades. As long as the market doesn't really break and violate the tunnel, then you are still in a valid uptrend. So here you can see the market broke above the tunnel. The RSI here is above 50, so you are in a clear uptrend. And then never did anything change here during this whole uptrending move. The RSI never dipped below 50. The price never broke below the tunnel until here was the first time that the 50 was broken. By then also the price was trading below the tunnels. And a new trend phase was initiated. So you may have been able to use a trend line here and then use a trend line breakout. And then here you have the breakout below the tunnel. The RSI is trading below 50, and you can see this was the case during all this downtrending phase. So a really, really great strategy, and especially if you have problems with staying in winning trades for a long period of time, the tunnel approach may help you establish a more objective trade management approach. And here another example. So we're looking at a bullish phase. The RSI is above 50. Here the price is outside of the tunnels. And you can see how long this was the case. And again, many traders have problems with staying in winning trades long enough. But such an approach with an objective tool like the tunnel is and may help those traders to just hold on to their winning trades for a long, long period of time. And then here we had the same thing on the other side. The break below the tunnel here was then the RSI trading below 50. And a new downtrending phase was initiated until the market broke on the other side, started a new uptrend, and this is how you may use this approach and those tools to complement your trading. So those are the 10 strategies that I picked for today's video. Let me know in the comments if you like this video, leave a thumbs up, share it with your trading friends, and make sure to tune in the next video.